Hey, welcome back. Thank you so much for joining me. This is Mr. Market. We're now into episode 33. So today I want to talk about what I think is the biggest hurdle to success when it comes to trading. I've been doing this for over 24 years, and this one factor has probably been the biggest source of my setbacks over my entire career. It's a well-documented psychological concept in behavioral finance, and it's called loss aversion. So what is loss aversion? It's basically the tendency to hold on to a losing position in order to avoid the psychological pain of being wrong. It's the equivalent of putting your head in the sand and pretty much refusing to acknowledge that you're wrong. And what's so dangerous about it is that when you have a losing position, it can possibly balloon into something far, far worse than you expect. And if you don't adjust and adapt to the new environment, that loss can significantly impair your portfolio. It's why I often talk about the importance of discipline and the types of pain that come with it. There's two types of pain that come with trading. Number one is the pain of regret, and number two is the pain of discipline. When you hold on to a position and it gets to the point where it hurts so much and you have to say uncle and sell at a massive loss, that is the pain of regret. And when you sell a position at a relatively smaller loss because your stops got hit or something fell through an important support level, and then eventually it possibly bounces back, that's a situation where you have the pain of discipline, where you were doing the right thing in order to prevent a larger loss. But sometimes the market reverses, and that's just part of the game. But let's not also forget that when we feel that pain of discipline, there are also many times when the market continues to fall after you exit. And it's that discipline to take that small loss rather than that much larger loss that pays down the road. So why exactly is it so hard to go take losses? If you take a look at this graph here, you can see the relationship between pleasure and pain. And if you compare the amount of pain that you feel, it's actually twice as large as the amount of pleasure that you feel. So if you are happy for having a gain, you can say, for example, you have 100 units of happiness, but when you have a loss, you feel 200 units of unhappiness. And so it's that magnitude, it's that amplified effect of losses that really hurts. And our egos are fragile. And a lot of the times we do not want to recognize that we're wrong. It's just terribly harmful for our well-being to recognize that we're wrong. And so what do? We hold on to the position. We hope that the market bounces back. We hope that our losses can get minimized. All the while, the market keeps falling and falling. It just gets larger and larger. And that is the problem that we are trying to avoid. Now, with that said, I acknowledge that it is terribly difficult to stay disciplined when you have a loss. I've been doing this for over 24 years, and it's still the hardest thing for me to go do. I still fail at it from time to time, and I did just this past week. When the pendulum algorithm gave me a sell signal on Wednesday the 18th, what I should have done was I should have shrunk my positions and or moved my strike prices lower. Now, I had put my strike price at $427, which roughly coincided with that upward sloping red trend line. That trend line is the one that goes all the way back to October of last year. And I was counting on the market to bounce because it was getting a little bit oversold. And I thought maybe traders would try to pick that as a level to try to hold and bounce back. But it didn't. It collapsed immediately right below it. And what did I do? I held on, but at least I had the discipline to go roll down my strike prices. I went down from 427, and then I rolled it down to 425, and then as it kept falling lower and lower, I had to roll all the way down to 422 by Friday. Now, yes, that did cause a loss, but rolling down was at least my way of being disciplined. It was my fail-safe mechanism. Sure, I still had my position sizes a little bit larger than I should have, but at least I reduced my damage by having a hard stop. And when my strike prices got hit, I rolled lower. Now, the good thing is that the market did bounce back over the past few days. And for this week, my strike prices are at $416 and at $415, expiring at the end of this week. and I retreated and put some strike prices at the $400 level, expiring all the way out in December. I think it's highly unlikely that it'll get there, but given how elevated the volatility has become, the premiums were nice enough that it was a good place to go park my money while I wait for things to kind of settle down. Now, it's super important to note that this primary uptrend since October is still broken to the downside, and the market is trying really hard to hold on to that 200-day moving average. Yes, the market's a little bit oversold, which usually suggests, especially since it's at such an important support point, that it can bounce from here. But for as long as the pendulum algorithm is giving a sell signal, I need to be very cautious, and that's why I am sitting way lower than the market at a very strong support level. Even though the short-term picture is pretty negative, it's really important to take a look at the bigger picture here. And if you look at the global earnings growth, you can see that the profit cycle had gone negative over the past year and is only now recently starting to go turn up again. So it's only a matter of time before the markets start paying attention to the actual positive earnings growth that we're experiencing, and it could take the market higher. And we've seen from the previous episode that the last quarter of the year tends to be pretty strong. So we have the seasonal factors and the earnings growth pointing in a positive direction to suggest that we could get a bounce back here. Now let's have a look at our trading performance. Year to date, we're up 18.65%, while the S&P 500 is up 12.03%. We have steadily been pulling away from the market. It tends to happen for us whenever the markets fall. We hold our ground quite well, and on average, we actually tend to make a little bit of money when markets fall, which is a big source of our outperformance. As a reminder, our goal is to earn 20% per year, and if we have a little bit of luck, we should be able to reach that within the next few weeks. And going back to our inception date of July 1, 2022, we've been able to go do just that. We're up currently 37.78%, while the S&P 500 is up 14.54%. So we have been able to meet our 20% goal per year. And going forward, I think as long as I remain disciplined, I think the odds are good that we can reach that goal. So that's all I've got for today. Thank you so much for joining me. And if you haven't yet, please click like and subscribe so then you'll know when my next videos drop. Also, you can find me on the web at mrmarket.us or mrmarket.us. And if you want to reach out to me, you can email me at mrmarket247@gmail.com. So thanks again for joining me. I wish you the best of luck in your trading this week, and I will see you next time.